everybody, hope you're doing well and had an awesome Labor Day weekend. Today I want to talk about yield, dividend-paying stocks and bonds. Where this constant low-yield environment, there's always a search for yield, creating income off of your portfolio. And one of the commandments a lot of investors out there have is, thou shalt not touch principal. Well, I want to explain how that can be a fallacy if misused. Let's say that you have a stock that you buy for $100 a share and it pays a 2% dividend. Once that dividend is paid out to the investor, that stock price is going to drop accordingly by 2%, and now the new stock price is going to be $98 per share. Now, some underlying factors can keep it up or make it drop even more during that time frame. When a company pays out, accumulates cash on their balance sheet, they have two options. They can pay out in cash to you, which is pay a dividend, or they can repurchase shares. Now, if they pay out cash to you as the investor, you have now taken on cash and you have an immediate tax liability. If they repurchase their own shares, then they have lowered the number of outstanding shares and theoretically created more value for you, the owner of the underlying shares. And this is a quote from a famous economist, Merton Miller, Nobel Prize winner, is this is a way, if a company's repurchasing shares and you sell and take capital gains, is really a way to create your own dividend. Oftentimes, it's not as tangible and you don't see it in your hand the same way as companies paying out dividends. The other way is in high-yield bonds. So nowadays, if the U.S. Treasury is paying 2.3, you need to take on some risk to achieve a yield. High-yield bonds, this is the H for the high, always means if the risk is here, there's higher risk on the back end of that. There is no free lunch. And whether that's default risk, whether it's duration risk, meaning you have to go way far out to get that high yield, there just really is no free lunch when it comes to investing. So ultimately, you have to think, what does it mean to you, the investor? And it may feel good psychologically to know that you don't have to ever make a sale to grab any income from your portfolio, but there's several issues arising from if a stock is paying a super high dividend in relation to its peers. First thing is, there's probably some underlying problem with that company, and when that problem is resolved, the dividend is ultimately going to be cut. And also the same with any sort of high yield investment. Looking back at mortgage-backed securities in late 2000s, 2006, 2007, when they were paying these tremendously high yield, and there was thought to be very little underlying risk, you could have seen the risk just by looking at the yield, because there is no real free lunch, and oftentimes you don't see that risk until it's too late. You have many other options. It's not just creating income from a portfolio. It means you need either high-yielding stocks or high-yield bonds. A globally diversified portfolio of, let's say, 60% stocks and 40% bonds, 60% throughout the entire universe, 40% fixed income throughout the entire universe, gives you roughly about 13,000 securities and a lot more protection than just weighing yourself too much in high yield, high dividend paying stocks and high yield bonds. This can get more complex. If you have questions, please give us a call, 770-984-2312. Click on the links to our website. Until next time, hope that money's making money for you.